All right, folks. Now we have chapter 4 and 5 in one because they're linked closely. So I did say I'll upload 5, 6, 7, 8 tomorrow, but it's going to be 2, 3, 4, and 5 today, and then 6, 7, 8 tomorrow. Now this chapter is going to talk about an example of a time-based model and how to trade it. It's an example. You don't have to stick to this one. You can if you want to, but it's showing you how to build and how to trade one. If you so choose, of course. The model is Wednesday model. And it depends on the daily and weekly candles. The weekly and daily charts are gold mines for those with a shovel, and a good one. The better quality your shovel is, the more money you will make with these two charts. We have here Euro, the weekly chart, which I called for you on Twitter. And in it, we'll see an important phenomenon, which is there's an 81% chance that the high or low of the weekly candle forms between the Sunday open and the Tuesday London session. And there's a 70% chance of Tuesday printing the high/low of the week. This is a concept discussed by many great minds in the realm of technical analysis. One of them, most notably, is William Gann. And of course, not a surprise, but also ICT mentions this in his teachings, which is true. Tuesday has a high chance to print the high of the week. And to make things even more focused, because I'm reminded of the quote, and this quote keeps popping up in my head the more I used to study the charts. Then I always had this in mind as I was learning, which is the quote of Arthur Conan Doyle. In the book Sherlock Holmes, where he says, once you eliminate the impossible, whatever remains, no matter how improbable, is the truth. Right? So once you eliminate the impossible, whatever remains, no matter how improbable, must be the truth. And that was an inspiration for one of my famous diagrams, which have circulated the internet, of the possible shapes of the daily candle, which I will link in the group. So as you can see, this is a beautiful example of a classic by week. There's many different ways the weekly candle can print. And you can trade them all. You can trade all of them. I can trade all of them. Anyone can trade whatever he wants. However, if you put all your energy, which you're wasting trading ranges, and I mean ranges when there is a chance of an expansion. Ranging markets are my favorite, but if there is a chance of an expansion and you only trade the range, then you're missing out. All right, so this shape, open, buy below the open, and then hold till the close. You don't close when it reaches this high. You close on Thursday. All right, so I'm entering on certain days and exiting on certain days, which will cap the range. You understand? In this case, I had alerted you, pretty much free money if you're focused, that this is the low of the week on euro. Monday, Tuesday, Wednesday mark the low of the week, and Thursday, Friday mark the opposing end of the range. Now, taking into consideration the two previous data points, this means that there's a high chance that Wednesday will print a classic buy/sell candle in the weekly and daily order flows direction. It's not a guarantee. And when I say buy and sell candle loosely, right? Because for me, as long as I can buy below the open and sell at the open, that is a success. As opposed to pattern trading the power of three. That is another mistake, right? So you'll trade the pattern. I'm trading the logic of open, low, high, and close. If you looked for trades which go from the protraction, the Judas swing, back to the open, and that was enough, that was all you did for the day, then you would find a lot more trades and you would be a lot more successful in catching trades. And in this instance, I'm reminded of another quote, which is, have an opinion on what the market should do, but don't decide what the market will do. Be happy with a percentage of the move. Variations depend on what day the PDRA is hit, which creates the weekly low. This is a rough depiction of the Wednesday model. Opening time, rise key level down to the opening price. All right, so the 1 o'clock candle creates the high of the day, and the 9 o'clock candle gives the retracement, protraction, and expansion. Price leg distribution number 1, protraction distribution number 2. Right? That in itself was a model just now. A more detailed look would be open, we rally, we are bullish on the higher time frame, right? Because you always have to pair one time frame with the other one. So we're bullish on the higher time frame, opening price, rally, fake out of the pattern Judas swing traders, range, so rally, range, turtle soup at a key level, turtle soup, breakdown. Now there's a change in the state of delivery on the higher time frame, which is a market structure shift on the lower time frame, right? An order block on a higher time frame is a breaker on the lower time frame, and a breaker signifies a market structure shift. That all comes second to the time all this is happening, right? Open, London, high of the day, New York OTE, and we go down. Here's a real life chart example of the Wednesday model. You have open. This is, of course, the 5 p.m. open, right? So if you want the midnight New York open, it's going to be around here, right? So open, decline, hit the key level, the previous low, retest the body of the previous low, right? Range low, range high, range low, retest the body of the previous low, and rally. On the higher time frame, you'd find a PDRA, which stopped this rally. This decline, excuse me. So open, decline, range low, change in the state of delivery, shift in the market profile, not a pattern, shift in the market profile. So we go from breaking lows and rejecting highs to finally breaking this swing high. As soon as we break the swing high, then we can start looking for a deep retracement, which will scare off anyone who bought up here and scare off anyone who's looking to buy, right? Because down here, you had dumb money selling. When you rallied, you had dumb money buying. And the market's function is to trip and offset as many positions as they can. Right? So someone, hopefully none of you, someone sold down here and bought up here and sold down here again because of decline, right? Pattern FVG, pattern trader. And those people are the liquidity which we rely on. And it is the logic I always have in mind. I never think what happened. I think, why did this happen? Right? As I'm living this candle alive, someone sold down here. Someone sold down here. Someone bought up here. Of course someone did. It's an old high, right? Range high. And beautiful range low to range high. Never changes. So back to Wednesday model. That is a price observation rant. I'll leave the details for the next chapter. Open, decline, create a range, turtle soup, break out of the range, and then rally. Another example of the Wednesday model over here. You have Wednesday. Open, range, when the time is right, turtle soup, change in the state of delivery, and a shift in market structure. The market profile has changed. We went from breaking lows to breaking highs. So now it's bullish. It's not a pattern. It's showing that smart money is no longer willing to sponsor the shorts. Right? As soon as you break above this high, you're bullish. Yes, but we wicked down here. Yes, but if you remove the wicks, you'll notice that we never closed a body below this low. Wicks do the damage, and bodies tell the story. And you'll notice this a lot about FVGs and order blocks. In fact, this is a good homework, which is go back and remove the wicks and see what you get. So open, range, turtle soup at 3 o'clock, right? Because we know that there's a recurring 2 a.m. model every day. And if 2 a.m. is a manipulation, then the manipulation is leading to a swing low at 3, right? 3 a.m. is an important time for turtle soup, which no one mentioned until I did, and then some people have recently started mentioning it, but nobody was aware of that time before I mentioned it. So it's good to finally see it going mainstream. 3 a.m. is an important time to look for turtle soup. Next up, you have the OTE continuation, right? So you have accumulation, manipulation, distribution, consolidation, expansion, retracement, smacking back into this range, and expansion again. These PD arrays, this inverse order block, these are all confluence levels with the consolidation. I don't care about them. They come secondary, but the consolidation, expansion, retracement, expansion is what matters more to me. Next up, how would one go about trading this model or any time-based model? Of course, with the demo money, if you so wished. because that's another important observation, which is teaching analysis versus teaching execution. In this one, I'm teaching you analysis. Execution is a topic for later. Number one, or step one, determine higher time frame, directional bias, and narrative. Bias is where, and narrative is why. 2, mark out the midnight opening price before opening time before midnight arrives. Mark a potential key level, which will mark the high/low of the candle you are willing to trade. Mark a liquidity pool. More on this in the upcoming chapters. Mark the CBDR/Asian range/flout standard deviations to approximate an area of the low of the candle or high of the candle to happen. Standard deviations are a good tool, but they are not. Again, they are all subservient to the element of time and the higher time frame key level, which always has a liquidity pool paired with it. Right? Wait for your pattern. And you see when the pattern happens, it's not look for an order block. It's look for all of this and then an order block. It might seem like much to do at the beginning, but it becomes second nature, like driving. Right? At first, you're looking at the mirror, the side mirrors, and the rear view mirror. You can't talk while driving, right? At the beginning, but eventually becomes second nature. All of that. And for those who drive a manual, which is more fun, you will also understand the learning curve of anything, of any skill. Number 5 is wait for your pattern to form below the opening price after the protraction has happened. Number 6 is memorize and write down your observations. If you're right, note and repeat. If you're wrong, note and avoid. And if you miss, note and catch it next time. That is the importance of a journal. It's not some diary, right? And I don't journal much outside of my patients and my trades. I think it's a waste of time. But in trading, it is an absolute must. So that's the idea, is opening time, key level marked out beforehand over here, protraction, expansion number 1 happening at this time, OTE, and then expansion number 2. The OTE means that a swing high will form, a predetermined swing high will form within the daily candle, smacking into the 1 hour candle, the 1 o'clock candle, excuse me. Right? This right here is the highest. If it's confirmed up here, then this is the highest probability trade you will take, even higher than this, because if there's one expansion leg, then it's very likely that you have another expansion leg due. If you have an expansion leg that broke market structure and shifted it, right? You see a high, low, higher high, and you break the low that broke the high with a massive swing, and there's a high chance there's another massive swing at least the same size, which is due. Procedure to show you how it's visually done, and I've never spoon-fed this much in my life, but the procedure is as follows. Number 1. Step 1 is determining the higher time frame directional bias. Candle number 1, candle number 2. If candle number 2 has taken the low of candle number 1 and has not closed below it, then there's a high chance that it retraces to 50% of candle number 1 and 100% of candle number 1. So Monday, Tuesday, Wednesday. 3 candle model for those who have attended the previous one, time and turtle soup, level 2, on the website. Shameless plug, yes I know, but it's really important. That is one of the most important lectures I've produced ever, and I cannot recommend it enough. The stuff in that lecture is actually, there are some things in there which I never intended to release to the public, but I did anyway. And the fact that I'm even reminding you that it exists, I'm slightly hesitant. However, it is crucial, which is why I'm reminding you. If you haven't got level 2, and you can, then get level 2. It's on the website, link in the bio of Twitter. So candle number 1 is over here, Monday. Candle number 2, Tuesday. This gives me a directional bias for Wednesday. Pair with that the fact that Wednesday has a high chance of being a classic buy or sell candle in the direction of the weekly and daily order flow. This gives me an excellent opportunity for a potential trade. So you have Monday, you have Tuesday, and you have Wednesday. Before Wednesday opens, we keep in mind that every midnight is a new opportunity. We have it marked. We have this rejection block marked. If we have long wicks or even stubby wicks for the order block, then this is swing high, and swing highs are usually good stop losses. Therefore, we mark the rejection block, and of course, the 1 o'clock candle produces the low, and the 9 o'clock candle produces the OTE. Accumulation, manipulation, consolidation, expansion, leg number 1, retracement, expansion, leg number 2, the order block to the pip, the opening price. And I have something very important to speak about regarding opening prices and closing prices in the next chapter. Consolidation, expansion leg number 1, retracement, expansion leg number 2. A very, very high chance that there is another leg after the market structure shift. So low, high, swing low, break the swing high, that broke the swing low, that caused a turtle soup. This high that caused turtle soup is broken with a massive expansion wave. There's a high chance that there's another massive expansion wave due. Add to that the fact that this long-wicked candle was disrespected. This wick is going to be used as the mitigation level, which smart money will use to mitigate their positions. And yes, they mitigate the positions. Price doesn't mitigate anything. That's a pet peeve I have, which is when people say that price mitigates. It doesn't. Traders mitigate their positions. Price doesn't. Rain's theory commentary. When the daily high and low are formed, then on the 15-minute time frame, you will find a range being souped. All right, this is 3 o'clock. That's one thing to note right now. If you're getting lazy, then snap out of it and write down that in your notes, which is the daily candle, the high and the low will form with a 15-minute range being souped at the high or the low. Another thing is this Monday range. This is a classic Monday low to high model, right? That is by itself a time-based model, which is discussed in depth in level 2, the advanced version. The basic premise is Monday, Tuesday takes out the low of Monday, does not break below it, It's a false breakout, seen by the number of closes and the lack of intention, the support as an idea. Smart money is supporting this low. It's sponsoring this low. Therefore, we can safely assume that Wednesday will take out Monday's high, or even Thursday. If there's a news event which will restrict Wednesday, then Thursday will take out Monday's high. That is how you also extract a directional bias on one time frame. Pattern traders, they saw this market structure shift and they were buying all the way down. They got stopped out, and then market went to their objective, right? So don't be a pattern trader. You see the difference. I'm not even looking at the pattern. I'm looking at the highs and lows, the market profile, and the ranges. The market profile broke the high. Okay, fantastic. But now we're rejecting this high and breaking this low. The profile on this time frame has changed, right? If you can trade one time frame, although I always advise my mentees against it when they ask. You can, but you shouldn't, right? But if you want to, at least do it right. Market profile, a high being broken, okay, we're bullish. However, now that idea is being negated by this rejected high. This rejected high gives you an insight into what smart money is doing. They are refusing to sponsor this high as a breakout. They're using this high to pair orders. Everyone's buying up here, right? OTE buyers all up here, and using that against them. It is confirmed when they break this low, the low that broke the high, or even this one, right? You see lack of intention of smart money to sponsor the lows and an intention to falsely break above the highs. Market profiling. That is, in summary, market profiling. Checking the highs and lows to see what is smart money sponsoring and what is smart money using as a pivot point to false breakout. So yeah, this open range, pre-opening range, soup, breakout, leg number 1, expansion leg number 1, retracement, expansion leg number 2. It's that simple. Consolidation, expansion, retracement, expansion. Leg number 1, leg number 2. Wednesday, classic buy day, right? That's the end of it. If you focused on catching 4 of these per month, instead of trading every single 1 hour candle you see, then you would have a much more successful career as a trader. That concludes chapter number 4 and 5. I hope you found it insightful. It was packed. And I wish you good luck and good trading, and see you in the next one.